Shares in the Asia Pacific are falling today as investors digest US economic data, but also China's industrial production and retail sales figures for August, which beat expectations. Output from Chinese factories grew 4.2% in August. That's up from a growth of 3.8% in the prior month. And the reading also beat estimates for growth of 3.8%. This indicates that a recovery in certain parts of the economy remains steady despite headwinds from new COVID-related curbs. China's unemployment rate also fell slightly to 5.3% in August from 5.4% in the prior month. Despite all this, Asian stocks are in the red this morning, and the Chinese yuan has weakened past 7 against the dollar overnight. For more on this now, let's go to Russ Mould, who is an investment research director at AJ Bell in London. Russ, many thanks for being with us today. So why this reaction in markets, in Asian markets this morning, in currency markets as well, despite these figures actually indicating that there is some kind of recovery taking place?
Yeah, I'm not so sure it's specific to the Chinese numbers, which, as you say, were probably a little bit better than expected. I think it's a continuation of the big picture macroeconomic trends that we're seeing around the world. Financial markets are transfixed by the prospect of the Federal Reserve continuing to tighten monetary policy, even if there's evidence that the global economy is slowing. That is frightening people into thinking that there'll be a global economic slowdown coming, and is also giving the dollar support because of the interest rate differential between America and the rest of the world. So I think it's a continuation of those two trends.
Interesting. In a way, do you think that the positive data that we've seen this morning coming out of China, are these data reflecting also the effects of the stimulus measures that were introduced over the past 2 months to revive economic growth? And China's also promised to increase spending in the third quarter to support the economy. What sort of impact is all of this having?
Yeah, China's been very proactive. There's already been stimulus. There's been support for the property market. There have been 2 interest rate cuts this year. We've only had 10 interest rate cuts worldwide from central banks in 2022, and China is responsible for 2 of them. And they do have that 5.5% GDP growth target, which I'm sure they'll be delighted to meet. But overseas investors are still concerned about the foundations of the Chinese economy, lots of debt. And in the long term, short term, you have lockdowns. And although debt is by no means a Chinese problem, you could say the same about Europe, the UK, America, and others. It still does have economists and investors wondering about the strength of the foundations of that economy and how sustainable the growth track really is.
Completely, the fundamentals there. And Russ, just one more question we've seen really moving markets this week has been the inflation report coming out of the US. And what does it tell us, in your opinion, about recession fears in the real economy?
If you look at the Atlanta GDP Now service from the Atlanta Federal Reserve in the US, that is now predicting a decline in economic activity in America for the 3rd consecutive quarter. So that is a technical recession. I guess the one saving grace at the moment is that unemployment is very low, job vacancies are very high, but in some ways, the stronger the job market remains, the better wage growth is, the more brave the Federal Reserve may feel in continuing to tighten monetary policy. And at the moment, its view is clearly that inflation is a bigger potential enemy than recession, and therefore it will continue to press ahead with, I suspect, further interest rate cuts, at least until you start to see the jobs market materially weaken.
Interesting. Russ Mould, many thanks for this update.